Welcome. Thank you for joining me on the LGPS pre-retirement webcast brought to you as part of Pensions Awareness Week. My name is Richard Quinn and I'm one of your pension fund representatives making up the employee relations team, and I will be guiding you through today's session. The purpose of this presentation is to provide you with an overview of the LGPS scheme and provide you with further information on the retirement process to assist you in planning for your retirement. If you do have any questions or would like to speak to someone in relation to your own pension, please refer to the Support is Available Now slide, which provides you with the different options how to contact WIPF, and a member of the team will be able to assist you. First, let's look at the key points that will be covered in today's session. I will provide you with an overview of the key benefits of being a member of the LGPS. I will talk to you about My Pension Online, which is the online portal you have access to take ownership of your own pension rights and view documents such as your annual benefit statement, which can assist you in planning for your retirement. I will guide you through how your benefits are calculated and built up in the scheme, covering final salary benefits for anyone who joined prior to the 1st of April 14, and the care scheme for anyone joined after the 1st of April 14. I will make you aware of the death benefits that are offered by the scheme, so on top of providing a pension for you at retirement, there is peace of mind that your loved ones will be taken care of. For those who are looking to plan for retirement, I will guide you through the different types of retirement and how you can access your pension benefits, and also discuss the protections that are built into your pension benefits. Finally, I will guide you through the retirement process. This will help you to understand what's involved in the process, what actions you may need to take, and what information we may require from your employer to give you a full understanding of what's involved. As a member of the local government pension scheme, there are a number of key benefits to just building up a retirement pot at your retirement. The local government pension scheme is an occupational defined benefit pension scheme which will be paid to you in addition to your state pension. Your state pension is a benefit which you become entitled to by paying your national insurance contributions, and it is calculated based on how many years you have been making those contributions through your national insurance. Currently, the state pension is around £185.15 per week and will begin to be paid to you between the ages 65 and 68, depending on your date of birth, and is payable for life. You might be thinking £185.15 is considerably lower than your current salary, but by joining the local government pension scheme, this gives you an opportunity to increase your retirement income to provide for a more comfortable retirement. The contributions you make attract tax relief, and therefore tax is deducted after your pension contribution has been taken from your pay. This means you pay less tax. In addition, your employer also contributes to the scheme too on your behalf. The local government pension scheme is a guaranteed comprehensive package of benefits which is backed by law. This means that when you retire, we have to provide you the level of benefits that you've built up, and this is not impacted by how well investments do or don't do, like some private pensions. In addition to an annual pension, you have the opportunity to convert pension to provide you with a tax-free lump sum. So depending on what suits your personal circumstances, you can receive a smaller annual pension to increase the tax-free lump sum you receive. Pension conversion works by every pound you give up. This will provide you with £12 of lump sum. This will be covered in more detail when we review your annual benefit statement. The scheme also has provision for a dependents pension for your surviving spouse, civil partner or eligible cohabiting partner, and eligible children, so you know your family will be provided for in the event of your death. Should the worst happen, there is a death in service cover including as part of your benefits of being a member of the scheme, and this provides a lump sum death benefit equal to 3 times your final annual pension will pay, should you die whilst in active employment. You can nominate who you would like to receive this payment by logging onto My Pension Online and completing the nomination section. Benefits can be paid early under certain criteria such as ill health. The LGPS scheme provides an inflation-proof pension, meaning it is increased each year in line with inflation, so it keeps its value. So for example, if it will pay for a loaf of bread in today's money, then it will pay for a loaf of bread when you retire too. The scheme offers contribution flexibility, allowing you the option to pay more or less into the fund to suit your own situation and affordability. And finally, as part of your membership, you will have access to the My Pension Online portal, which is the online service we offer, which enables you to view your benefits, update your personal details, and access documents in relation to your pension, such as your annual pension statement. So first of all, I'd like to make you aware of My Pension Online portal you have access to. So My Pension Online is a portal that gives you the tools to access information about your own pension and put you in the driving seat to take ownership of your pension. So from the online portal, you can review your membership details, update your contact details, update your death grant nominations, and access your documents in respect of your pension, such as your annual pension statement or P60s if you are in receipt of your pension. The online portal is designed to give you a snapshot of your pension, which gives you the opportunity to ensure the information that we hold is accurate and up to date. This is why we encourage you to carry out regular checks. So this ensures the information we do hold is accurate and up to date, and also means there aren't any unnecessary delays when it eventually comes to processing your retirement benefits. So you can view using the 4 tabs. So that's the membership details, personal details, change my account, and view my documents. So when we say carry out regular checks, so for example, this is ensuring your hours and service is up to date, your contact details are correct, you've registered your death grant nomination, or if your circumstances have changed, you can revisit and change your death grant nomination as you see fit. You can also access your annual pension statement or P60s if you're in receipt of a pension as well. For any members who join the scheme prior to the 1st of April 2014, the way your pension benefits are calculated are different to how they are currently calculated. These benefits are referred to as final salary benefits. I'll now guide you through how these pension benefits are calculated. So final salary benefits are calculated using your pensionable service, your full-time equivalent final 365 days of pensionable pay, the appropriate accrual rate. So whatever your full-time equivalent rate of pay is in your final year before you retire, this is usually the pay figure we will use when calculating your final salary benefits. So to clarify, the accrual rate is simply the rate at which your benefits build up in the scheme. Let's take a closer look at the final salary benefits within the scheme. So for each year of membership built up in the period up to the 31st of March 2008, you receive a pension of 1/80th of your full-time equivalent pay against your pensionable service, and it also provides an automatic lump sum of 3 times your pension. For membership built up between the 1st of April 2008 and the 31st of March 14, you will receive a pension based on a 1/60th accrual of your full-time equivalent final pay and service. So if we look at the example on the slide, we can see the box on the right that this member has built up 10 years service under the 80th accrual rate and 6 years under the 60th accrual rate. So using a final salary of £20,000, this has provided them with a total annual pension of £4,500 per year. This is increased each year in line with inflation and payable for the rest of your life. In addition, it's given an automatic lump sum of £7,500. Final salary benefits only relate to benefits where a member was in the scheme pre-1st of April 2014. As part of the calculation of your final salary pension benefits, we would require information from your employer confirming what the full-time equivalent final pay is in the last 365 days up to your date of leaving. As part of providing this information, your employer will automatically look to see if a previous year's pay is higher looking at the best of the last 3 years to ensure we're using the highest pay possible when calculating your pension benefits. If your pay has been reduced because of sickness, then the final pay is the pay you would have received had you not been off sick. This is to ensure your benefits are not disadvantaged as a result. One of the protections built into the LGPS is designed to ensure you are not adversely affected if you receive a reduction in pay. The protection is built in for 10 years following a pay reduction and only applies to your final salary benefits. So if you've received a reduction in pay as a result of a job evaluation or regrading, we will look to ensure that a higher final pay is used in the calculation of your final salary pension benefits. This is in addition to the best of the last 3 years. So a reduction in pay certificate is built into the system, and we will contact your employer at retirement for this information. In April 2014, the local government pension scheme changed from a final salary scheme to a career average revalued earnings scheme known as a care scheme. So from the 1st of April 14 onwards, benefits built up in the LGPS are calculated under the rules of the care scheme, with any membership built up before April 14 falling under the final salary benefit regulations. Care benefits, however, are calculated differently. So under the care scheme, your pension builds up as an average of the pay that you receive throughout your career. The more you earn, the more your pension builds up to provide you with a guaranteed income on retirement, and this is payable for every year for the rest of your life. Your care benefits are revalued in line with inflation, and the normal pension age is linked to your individual state pension age. With the introduction of the care scheme, it allows flexibility in respect of your contributions, so you can elect at any time to join the 50-50 section, where you only pay half the contributions and build up half the pension. However, you still retain all the key benefits offered as part of being in the main scheme. So calculating the care pension. So each year, the annual pension you purchase is revalued in line with inflation based on the Consumer Price Index, known as CPI. This allows the pension to retain its value through to retirement and in line with the cost of living. So if you can afford your favourite takeaway coffee now, you will also be able to do this in the future. So if we look at the example on the slide, the pension pay this member received is £18,500 per annum. The accrual rate, if you're in the main care scheme, is a 49th. So a 49th of £18,500 would purchase an annual pension of £377.55. If the member was in the 50-50 section scheme, the accrual rate would be a 98th and would mean you would build up half the pension had you been in the main care scheme. So now what I would like to do is just go through an example of how your pension builds up to give you a better understanding of how your care pension works. So for this example, we were making the following assumptions. So actual CPI for the first 4 years and then 2% thereafter. This member has steady pay increases each year, and they have a starting salary of £18,500 in the first scheme year. So if we look at the first scheme year, there is no opening balance as the member has only joined the scheme. So with a salary of 18,500 divided by a 49th, that means this member has built up £377.55 worth of pension. We then adjust this in line with inflation and cost of living. So we add £9.06 onto the £377.55, which gives us a balance at the end of year one of £386.61. In year two, the closing balance of the previous year becomes the opening balance. So there's £386.61 added to the opening balance. Following an increase in salary to £19,000, the pension built up in year two is £387.76. Again, we just divide the annual salary by a 49th. So then when we add together your opening balance with the pension that you've built up in that year, that gives you a pension pot that now stands at £774.37. Again, we adjust your pension pot in line with inflation, so we add the £13.16 onto your balance, and your pension pot total at the end of year 2 now stands at £787.53. In year 3, the opening balance brings forward the previous year's total of £787.53. Another pay increase to 20,000 means the pension built up in year 3 is £408.16, and the new pension total is £1,195.69. We add on the adjustment for inflation of £5.98 and gives the total account accrued at the end of year 3 of £1,201.67. In year 4, you will see the closing balance of the previous year has been brought forward. Another pay rise, which means the pension built up for this year is £428.57, which provides a new account total of £1,630.24. The total is again adjusted in line with inflation, so we've added £50.54, which gives a total account at the end of year 4 of £1,680.78. Now we've jumped here to year 10, just to give you an indication of what the benefits would look like after 10 years. So the same process has happened for year 5 through to year 9, which gives an opening balance of £4,388.05. The pension built up in year 10 is £510.20 following a increase in salary. The pension account in line with inflation is adjusted, so we add £97.97 to the total, and the total pension account at the end of 10 years is £4,996.22. So after 10 years of building up pension, there is an annual pension payable of £4,996.22. This is payable for life, and just like when you're building your pension account up, your pension is also index linked, so it retains its value. At retirement, you have the option to convert part of your pension to produce a lump sum. There are limits set by HMRC in respect to the lump sum, and I will cover this more in the next slide. At retirement, you also have the option to exchange pension to provide you with a tax-free lump sum, and this is done on a conversion. For every £1 of pension you swap, this gives you £12 of lump sum. So when it comes to retirement, if you feel that a smaller annual pension would suit your own situation or affordability, you can increase the lump sum you can receive by converting pension to lump sum. This gives you access to a lump sum to use as you see fit, so whether that's traveling the world, doing some home improvements, or just helping out loved ones. HMRC do set a limit on the maximum lump sum of 25% of the capital value of accrued rights. So we ask for additional information at retirement from you just to ensure that you do not exceed these limits. This has no effect on the level of survivor's pension that is provided under the scheme regulations, and you will only need to make a decision in regards to your convert pension to lump sum when you're claiming your benefits. Each year, we are required to provide you with an annual pension statement. So this will show you the current value of your pension benefits and also provide you a forecast up to age 65 and your state pension age. So what this will do is this will provide you confirmation of what your standard benefits package is, and also if you elect to convert your pension to provide a maximum lump sum. So as we'll see on the slide, at age 55, the value of the benefits are £12,214.09. However, if you elected to convert some of that pension to provide a lump sum, then your annual pension would reduce down to £7,851.92, but it would provide you with a tax-free lump sum of £52,346.04. And again, at age 60, a standard benefit package of £18,287.88, But if you were to convert pension to provide a maximum lump sum, your annual pension would reduce down to £11,756.50, but it would provide you with a maximum lump sum of £78,376.56. As we've seen, the scheme offers many other benefits in addition to providing a pension at retirement. The death benefits offered by the scheme offer peace of mind in the knowledge your loved ones are provided for in the event of your death. Entitlement to death benefits starts from the day you join the scheme. There are two elements to your death benefits, and these are designed to cover you as an individual. So as an active member of the scheme, the death in service benefit would be paid as a lump sum death grant equal to 3 times your annual pensionable salary. When you become a pensioner, although your pensionable is payable for life, it does also offer a 10-year guarantee. This basically means should you die within the first 10 years of receiving your pension, the balance of those 10 years worth of pension would be payable as a death grant. After the 10-year period, no death grant would be payable in the event of your death. However, there would still be provision for dependents' benefits subject to meeting the necessary criteria. So in addition to a death grant, there are survivors' pensions that may also be payable. So it's either payable to a widow, widower, civil partner, eligible cohabiting partner, or to dependent children subject to them meeting the necessary criteria. It is important that you nominate who you wish to receive any potential death grant. This could be a partner, brother or sister, parent or a child, or even a charity of your choice. And this can be done via My Pension Online and can be amended at any future date should your circumstances change. Now I'd like to provide you with further information on retirement. Here we will look at when you can retire, protections that are built in, and also we will look at the retirement process, and finally, when you do claim your pension, when will it be paid? So when can you retire? You can choose to retire and take your pension at any time from age 55, provided you have met the 2-year vesting period in the scheme. So you can access your pension from early as age 55 or right up to age 75. If you choose to take your pension before your normal pension age, it will normally be reduced. However, if you take it later than your normal pension age, it will be increased because it's being paid later. Whatever you decide, please note that you must come out of the LGPS before your 75th birthday. This doesn't mean you have to take payment of your pension at this point. Recent changes allows you to defer payment after your 75th birthday. Your LGPS pension is payable from your normal pension age, which is linked to your state pension age. The LGPS makes the assumption that you will normally access your pension from your normal pension age. However, as you can access your pension earlier, anywhere from age 55 upwards, to account for accessing your pension earlier and your pension being paid for longer, reduction factors may be applied to your pension benefits. These are based on the number of years early you're accessing your pension benefits and take into account they will be paid earlier and for longer than anticipated. Please note that if you do decide to access your pension after your normal pension age, then your pension is uplifted to account for the fact your benefits are being paid after than anticipated. Further protections are built into the LGPS to limit the reductions that apply to your benefits. This is known as the Rule of 85. So it applies to members who joined pre-1st of October 2006 and allow members to take their pension earlier with smaller reductions on their pension. It works by adding together your service and age, so that's service in whole years. And if this equals 85, then you may have protections to the reductions that are applied to your pension benefits for taking them earlier. The Rule of 85 comes into effect with a minimum age of age 60. Please note that the 85-year rule is built into all estimates, so we do recommend requesting an estimate for an accurate value of your benefits prior to your planned retirement date. As there have been changes to the scheme over the years, what is referred to as your normal pension age has changed in line with those changes. So any benefits built up to the 31st of March 2008, then your normal pension age is age 65 or age 60 if the 85-year rule is satisfied. Benefits between the 1st of April 2008 and the 31st of March 2014, your normal pension age is age 65. And benefits from the 1st of April 14, your normal pension age is linked to your state pension age. So what are the different ways you can retire from the scheme? You can choose to retire and take your pension at any time from age 55, provided you have met the 2-year vesting period in the scheme. If you choose to take your pension before your normal pension age, it will normally be reduced. However, if you take it later than your normal pension age, it will be increased because it's been paid later. Whatever you decide, please note you must come out of the scheme for your 75th birthday. So from age 55 to 75 allows you to access your benefits from age 55 and no employer consent is required for this type of retirement. However, your benefits may be reduced as you are taking them early, but it will take into account the rule of 85 if that applies. Flexible retirement is worth considering if you would like a more gradual move into retirement. From age 55, if you reduce your hours or move to a less senior position, again, provided you have met the 2-year vesting period and your employer agrees, you can take some or all of your pension benefits you've built up, helping you ease into retirement. Each employer has their own individual policy on flexible retirement, so you do need to liaise with your employer if you are interested. As your employment is continuing, you would be eligible to rejoin the LGPS on your reduced hours or grade and build up further benefits, which you would then claim when you retire from your post. Another potential scenario is a redundancy or efficiency retirement. So should your employment be terminated for either of these reasons, provided you are age 55 or over, and again you meet the 2-year vesting period, your main benefits are payable immediately without any early retirement reductions. If you are under 55, then your pension benefits will be deferred in the scheme. Ill health retirement. So the local government pension scheme has the provision to pay an ill health pension, and this is known as ill health retirement. In order to be granted an ill health pension, a formal process must be followed. Firstly, the severity of your illness and the effect this has on your ability to work both now and in the future will be assessed by an independent registered medical practitioner who would be appointed by your employer. If approved, this would then be used to determine the level of benefit awarded. There are 3 different tiers which can be awarded for an ill health retirement. You could be awarded Tier 1, so if you're unlikely to be capable of gainful employment before your normal pension age, the ill health benefits are based on the pension you've already built up in your pension account at your date of leaving the scheme, plus the pension you would have built up had you been in the main section of the scheme until you reach your normal pension age. You could be awarded a Tier 2, so if you're unlikely to be capable of gainful employment within 3 years of leaving, but are likely to be capable of undertaking such employment before your normal pension age, ill health benefits are based on the pension you have already built up in your pension account at your date of leaving the scheme, plus 25% of the pension you would have built up had you been in the main section of the scheme until you reach your normal pension age. And finally, you could be awarded Tier 3, so if you are likely to be capable of gainful employment within 3 years of leaving or before your normal pension age if earlier. Ill health benefits are based on the pension you've already built up in your pension account at leaving. There is no enhancement attached to a Tier 3, and payment of these benefits will be stopped after 3 years or earlier if you are in gainful employment or become capable of such employment. When you're approaching retirement, we do recommend that you request an estimate from your employer 6 months before your proposed retirement date. This is so that we can provide you with an accurate indication of the level of benefits you can expect. Although we do provide an indication of your pension benefits at key dates on your annual pension statement, this is based on the estimated information we hold and is not as accurate as an estimate. This will be based on more up-to-date information. Your estimate will include both your standard benefits payable and the maximum tax-free lump sum and subsequent reduced pension if you elect to convert pension to provide a tax-free lump sum. Once we have been notified of your intention to retire, we will calculate your pension benefits and issue out your retirement pack. Your retirement pack contains confirmation of your benefit options, so this will be the standard package of benefits, and also confirmation of your pension benefits if you wish to convert pension to provide you with a maximum tax-free lump sum. Included will be your pension claim form, from which you would use to advise us you would like to claim your pension benefits, and also where you provide us with confirmation of the bank details of where we pay your pension benefits. In addition, this will ask you to tell us about any other pensions you may have to ensure you do not exceed the limit set by HMRC in terms of the maximum lump sum you are able to take. Once you are in receipt of your pension, when and how are your benefits paid? Your pension will be paid the middle of the month. Your pension is subject to PAYE income tax. Your lump sum is payable and will be paid shortly after your retirement date. Your pension will be revalued every year using CPI. You can view your P60 via the My Pension Online portal. And please note, if you make an AVC contribution from your final salary payment, the payment of your pension will be delayed. I would just like to make you aware of some of the additional resources that are available to you to aid your understanding of the LGPS and can assist you when you do start to look and plan for your retirement. You can access the WYPF website, which has a wealth of information in relation to your pension. There is a dedicated website from the local government actuary, which is member designed website to provide you with additional information to help you understand your pension. The final two resources are websites that you can access to assist you when it comes to retiring and planning the life you would like to live. So the Retirement Living Standards website helps you to picture what kind of lifestyle you could have in retirement. And the Money Helper website makes it quicker and easier to find the right help and offer support and guidance on all financial matters. If you have any specific scenarios you're struggling with or still require some assistance, then please do get in contact with us. The contact details you can use are displayed on the slide. So you can contact the contact centre either via the team mailbox at pensions@wypf.org.uk. You can call the contact centre on 01274 434 999. And again, you have the WYPF website, which gives you a wealth of information in respect of your pension. So just want to read out this disclaimer. So this presentation is issued by West Yorkshire Pension Fund to assist the stakeholders and partners associated with West Yorkshire Pension Fund. The information has been prepared on the fund's current understanding of the scheme regulations. Therefore, it would not be treated as a complete authoritative statement of the law. Users may wish or will need to take their own legal advice on the interpretation of any particular regulations. No responsibility whatsoever will be assumed by the fund for any liability, financial or otherwise, incurred by stakeholders relying on this statement. The fund does not accept any responsibility for reliance on the contained or referred to in this guidance. And finally, thank you for joining me for today's session. Hopefully that's given you a bit more information and understanding of how your pension works and how you can better prepare for your retirement. Okay. Thank you.